Cari fan, care fan di questo canale, oggi abbiamo il piacere di avere un ospite davvero eccezionale. È il professor Hanno Lustig, belga, quindi europeo, però professore all'Università di Stanford. Allora, perché abbiamo invitato lui a questa nostra trasmissione? Perché di recente lui ha presentato un paper che è di straordinario interesse. Alcuni dei temi che lui e il suo team, i suoi coautori affrontano, erano emersi in passato, soprattutto in relazione a Target 2, che è il sistema di pagamenti nell'area euro. Comunque, per essere precisi, il paper che il professor Lustig e i suoi coautori hanno presentato si chiama What Does It Take Quantifying Cross-Country Transfers in the Eurozone? Gli altri autori sono Yili Chen, Zhengyang Yang, spero di pronunciare bene, Matteo Leombroni e Hanno Lustig, ovviamente. È stato presentato al San Francisco Fed Microfinance Event, Seminar, non so come definirlo. Ma comunque, adesso noi parleremo in inglese perché, insomma, il tema richiede una certa precisione, per quanto il professor Lustig capisce l'italiano, però è meglio che ce lo spieghi nella lingua diciamo così, della scienza internazionale, così che tutti possano capire e che tutti abbiano una nozione precisa di cosa stiamo parlando. Ok, first of all, Professor Lustig, thanks a lot for accepting our invitation. It's a true honor to have you with us. And the basic message of this paper is that the monetary union has turned out to be, if not primarily, certainly quite substantially, a fiscal union. For those who, for those who have an advanced degree in economics, this is it's not out of this world, because monetary policy and fiscal policy, as Thomas Sargent highlighted long ago, and as many others have underscored, monetary policy and fiscal policy are directly linked. But the strange aspect of this intertwining and of what resulted from the monetary union is that it was totally unexpected. If I may go back to the Maastricht Treaty, the fathers, I would say, of the euro knew that there was this intimate links between monetary and fiscal policies. That's why they designed the famous Maastricht parameters. And they designed those Maastricht parameters, 3% deficit to GDP of 3%, debt to GDP no higher than 60%. Actually, the target for the deficit to GDP percentage was 0. 3 was the upper limit before sanctions, before fines would be triggered. So they were aware, and they designed a fiscal framework, not particularly sophisticated, but at the time it wasn't, expected to be sophisticated. So a set of simple rules to avoid the contamination between fiscal and monetary policy. When the Stability and Growth Pact, or let's be more honest, when the whole framework of the fiscal rules came into question, and that was, an outcome of both France and Germany reneging on their pledge, the whole picture changed, and monetary policy started to contaminate fiscal policy and vice versa. So, Professor Lustig, I don't want to go much further in. Tell us what has happened and why this contamination is so worrisome.
Thank you, Fabio. That's an excellent question. Let me dive right into it. I think you hit the nail on the head. What we're arguing in our paper is that within the current institutional framework, when the European Central Bank runs a large balance sheet, as it currently does, at its peak, it was larger than 1/2 of the Eurozone's GDP, that inevitably, along with that, there are large cross-country fiscal transfers. And in particular, what we document is that there are large transfers from the core of the Eurozone, countries like Germany, the Netherlands, Finland, to the rest of the Eurozone, and in particular to countries in the periphery. Historically, that's been countries like Italy, but also Portugal and Spain. Now, let me give you sort of a quick intuition for why these transfers tend to happen when the European Central Bank runs a large balance sheet. Well, what the European Central Bank does is when it, for example, says, okay, we want to start buying bonds issued by our member countries, by the governments of our member countries. Let's take Italy as a concrete example. Then what it does is it tells the Banca d'Italia, the Italian central bank, you can go ahead and buy Italian bonds. But typically what happens is that the Banca d'Italia will buy Italian bonds held by, say, a German bank. Let's take Commerzbank in Frankfurt. And so let's suppose that the Banca d'Italia buys 100 million euros in Italian bonds from Commerzbank. Well, the way this works within the Eurozone is that Commerzbank then gets a credit of 100 million euros in its account at the Bundesbank in Frankfurt. And then what the Bundesbank does is it says, well, I now have a claim on the Banca d'Italia through Target 2, which is the payment system that you mentioned in your introduction. Okay. Now, this is all kind of convoluted and complex, but what really is happening then in the background is that through this Target 2 system, Italy, the Italian government, in a broad sense, if you consolidate the Banca d'Italia and the Italian Treasury, is borrowing from Germany at essentially the risk-free rate. So it's borrowing from Germany at a rate that is much lower than the market rate, which would be the yield on, say, Italian government bonds. That in and of itself means that inevitably, whenever the ECB expands its balance sheet by buying back government bonds, what tends to happen is that there are these transfers, because now we're allowing Italy, we're giving Italy a good deal, we're allowing Italy to borrow at a below market rate. Now you might wonder, well, why does this happen this way? Why are the reserves, the bank reserves created in Germany, why does Commerzbank prefer to hold reserves in Frankfurt? Why is that the equilibrium outcome? Well, that tends to happen because people are worried about the possibility of one country presumably a periphery country leaving and then redenominating its currency. And so if you have a choice, you'd prefer to hold reserves in a core country like Germany, because then in the event of a breakup of the euro, you're probably going to be better off. So that's a long answer, but the bottom line is that the way the Eurozone system works, the way the ECB runs its balance sheet, whenever it tends to expand its balance sheet, it is funding that by issuing reserves in core countries. And then what that inevitably implies is that the periphery is then borrowing implicitly from the core at below market rates, and that gives rise to these fiscal transfers that you mentioned at the beginning. Now, we can debate whether or not that actually constitutes a de facto fiscal union. I think reasonable people might disagree about that, but it's certainly true that the actions of the European Central Bank have substantial fiscal consequences through these transfers. And that takes us back to what you said about Tom Sargent and his original insight that monetary and fiscal policy are always coordinated. But sometimes, and I think he points this out in his Nobel Prize lecture, in obscure ways. And in the Eurozone, this works in obscure ways. It's not a very transparent, opaque arrangement, and it takes a little bit of digging to understand what's going on.
Oh, the other element that somehow caused unintended consequences was target two, because target two was supposed to be a simple, let's say, almost innocuous payment system, but it became the instrument through which countries, economies borrow and lend, are forced actually to lend and on demand from borrowers. For example, imagine that an Italian wants to keep money in a German bank account. So he closes his bank account in Italy, let's say in Rome, in Milan, in Genoa, in Venice, wherever, and opens a bank account in Frankfurt, in Berlin, in Munich. What happens exactly, Professor Lustig?
Well, what's going to happen is that when the Italian citizen opens a bank account in, say, Frankfurt, the bank, let's say Commerzbank in Frankfurt, will sort of give him this euro bank account, but implicitly in the background, what's going to happen is that as a result of this, the Bundesbank will accumulate a claim on this target 2 system that you were hinting at before, because if this is like a 500,000 euro deposit, the Bundesbank will accumulate a claim on the Banca d'Italia in the amount of 500,000 euros. And so what we've seen when we look at these target 2 balances over the past 2 decades is that they've grown tremendously. And that's partly the signature of the example you gave, capital flight, but it's partly also the signature of a more general phenomenon, which is that investors, households, will prefer to hold deposits in poor countries because they're worried about redenomination risk, right? And that's why the Eurozone is fundamentally different from the dollar zone, where I live, the US. Presumably, there are large imbalances in the payment system within the Federal Reserve System as well. But those don't really matter, and nobody pays any attention to them because nobody's worried that the district that I live in, within the Federal Reserve Bank of San Francisco's domain, that we will leave the dollar zone. So the fundamental driver of all this is that there is perhaps a small but a non-zero probability of one of these periphery countries at some point exiting. And that means that people will prefer to hold safe assets in core countries. And so whenever the ECB expands its balance sheet, what it then tends to do is it tends to issue reserves. So these reserves, to be clear, are reserves that are held, say, at the Bundesbank. So these are like deposits that are held by banks at the central bank, the German central bank. It tends to fund the expansion of its balance sheet by issuing these reserves, say, in Germany or the Netherlands and Finland. But then, of course, in the background, what the German central bank has to do, the Bundesbank, is to offset what's going on its liability side. It's going to, on the asset side, book a claim on the Target 2 system, right? So if it sort of, if it issues 100 million in euros as reserves because the Commerzbank bought 100 million of Italian government bonds, then on the asset side, it says, okay, I now have a claim on the Banca d'Italia, the Italian central bank, of 100 million euros. And why is this important? Because people will often dismiss this and say, well, but we know that these Target 2 claims are perfectly safe. So why worry about these Target 2 claims? But the fact of the matter is that we actually don't know that. These claims are not formally senior to, for example, government bonds. So it's not the case that in case of a default or a redenomination, that Italian government bondholders would be second in line to these Target 2 claimants. And in fact, the best evidence we have that these Target 2 claims are not really risk-free is from the effects of quantitative easing within the Eurozone. So typically when the European Central Bank does quantitative easing by buying back government bonds, for example, Italian bonds, the spread between Italian and German yields decreases, which means that the market now thinks that Italian government bonds have less credit risk than before. But if Target 2 was perfectly safe, we should see the opposite. Because if you believe that Target 2 claims are safer than government bonds, that whoever has these Target 2 claims will come first, that actually should have the opposite effect. Because now the people who own the government bonds, who are second in line, would be worse off, right? But that's definitely not what we see. So this usual claim that is often repeated, but without a ton of evidence that Target 2 claims are perfectly safe. I don't think there's any empirical evidence for it, but there's also no evidence if you sort of look at the rules and regulations and the institutions themselves.
No, but that's actually very true, because several years ago, in Italy, there was a political party, well, bunch of people who were arguing, were pushing for the Italexit, for the for Italy abandoning the monetary union, as parroting, I would say, the Varoufakis ideas during the Greek crisis. And at some point, at that point, the Target 2 issue, the large imbalance, came to the fore, became, I want to say, part of the political debate, but certainly people like Mario Draghi at the time said, well, you want to exit from the euro area. Well, think twice because you have these huge liabilities vis-a-vis target two, and somebody has to pay those. The debate, I mean, the argument wasn't settled, but it lingered, and it has lingered since then. We still don't know what is the legal basis of those claims, because the euro is the irrevocable currency of the euro area, or actually it should be for the entire European Union. So apart from Denmark now, before there was also the UK who had this opt-out clause. Now only Denmark has that privilege, but every other European Union member country has made a pledge to join the euro area, to join the monetary union, as soon as the Maastricht parameters are met. So
Yes.
I want to say that just for to give a complete information. But now the issue, okay, this huge fiscal transfer, this fiscal union is not enough, because obviously the benefits enjoyed by countries with, let's say, less credible fiscal policy still can put their house in order. Okay. And one of the main proposals to give a boost to the European economy, to solve the euro area's problem, to jumpstart a new cycle of growth, hinges on the euro bonds, that is, on the issuance of debt not issued by by national government, but issued by the European Union, or better to say, the euro area countries. What do you think about that proposal?
Yes. So
how would it exacerbate or solve this whole picture that you gave before?
Yeah. So I'm very skeptical about Eurozone bonds, and here's why. So why are we in this predicament where a number of European countries, including my native Belgium, by the way, have completely exhausted fiscal capacity, and actually to the point where they're no longer investing in essential functions of the state, like defense, for example? Why is it that Belgium hasn't invested in defense? Well, it's because they really have no fiscal capacity. They've made all these promises to Belgians in terms of transfers that they want to keep, and tax rates are already quite high. And I think Belgium, in that sense, is a lot like Italy. And so the government is stuck between a rock and a hard place. But the question is, why did we end up in this situation? And I think it's partly because the system that we've created in the Eurozone with these large transfers and implicit guarantees has, first of all, blunted the signals that the bond market usually provides to politicians, right? An essential function of the bond market is to signal to a Belgian politician when he or she has run out of fiscal capacity, so that they realize, okay, I probably have to scale back my spending plans or look for other sources of revenue because I'm tapped out. I no longer have fiscal capacity. I would argue that over the past 10 to 15 years, because of all the measures that have been taken in the Eurozone by the ECB in particular, those signals have been blunted dramatically. And essentially, Yields have not been allowed to price in fiscal news appropriately. Um, so that's one thing, is that politicians are not getting the right signals from the bond market. And also the incentives are mixed, right? Because if you're a good politician and you realize that there's an implicit backstop for your country by the European Central Bank, I don't think you have a strong incentive to start running big surpluses, which you probably would do if you couldn't depend on the European Central Bank bailing you out through something like TPI, the Transmission Protection Initiative, which we haven't talked about yet, but maybe we can talk about
Yeah,
it
yeah.
later.
We'll have
Right. So now,
a
so I
little
think
discussion on that.
yeah, so this is kind of a long-winded answer, but I would say that the reason we're in this position now is partly because the bond market hasn't been allowed to do its job. Okay, so now let's think about Eurobonds. Well, I think that that's probably going to make this problem worse, not better, because now you're trying to sort of insulate, let's say, Belgium somewhat from what happens to the yields on Belgian bonds. But that, I think, worsens the problem, doesn't make it better, because now Belgian politicians who are good at their job will think, you know what, I've got this additional way of tapping the bond market where the yields are not that responsive to what I'm doing, but they're determined mostly outside of Belgium. And so I could probably be a bit more aggressive when I come up with a government budget. The only way I think personally that a federal system with euro bonds can work is if there is a dramatic reduction of the fiscal sovereignty of the member states. What do I mean by that? Well, we would have to tell the Belgian government there's going to be strict limits on your budget deficits, on what types of spending you're allowed to fund as a government, and those will be enforced. So they will not be like the Maastricht criteria you mentioned earlier, where all countries sort of routinely have ignored these rules, but these rules would have to be enforced and they would have to be binding. So the Italian government budget would not just be determined in Rome, but it would also be determined by guardrails and strict rules in Brussels. And so if you ask me, is that feasible in Europe? I'm very skeptical. I have not really met many Europeans who would sign up for something like that, for something where the Italian government budget would be determined not in Rome, but to a large extent outside of Rome. But I think that is the inevitable quid pro quo that one would have to be willing to engage in. Eurobonds are not a free lunch. The only way I think that can work is if we make sure that we provide the right incentives where individual member countries cannot free ride off of the Eurozone as a whole. And so far in the Eurozone, we've been sending the wrong signals. Let me end by quoting Tom Sargent again in his Nobel Prize lecture. He actually talks about this problem in Europe and compares Europe, which I think is a great comparison, to the 19th century United States. Okay, and so when the United States was formed, initially, actually, there was sort of a bailout of the states. So there were states who had not paid back their debt that they had issued because they were fighting the British in the War of Independence. And so Hamilton brokered a compromise between the states where the debt of the northern states was going to be assumed by the federal government. So that's called the assumption of the debt. And actually, interestingly, the compromise was we'll put the capital in the South, in Washington, D.C. That was to placate the southern states who had already paid back their debt. So that was the compromise. So that was sort of a bailout. So the US started with a bailout, not a great start. But then in the 1830s and 40s, a lot of states got into trouble because they had borrowed way too much to fund railroads and other things. And then the federal government said in the 1840s, told the states, you're on your own. And there were states like Mississippi that actually defaulted. So Sargent makes the point that Europe has not had that moment. We really haven't had the moment where the European central authorities, be it in Brussels and Frankfurt, tell individual member states, you're on your own. We've never had that moment. We've instead put together a patchwork of implicit guarantees, bailout guarantees, and all sorts of other fixes that really provide bad incentives, I think. And by the way, when I say bad incentives, I don't blame politicians in whether it's Belgium or Italy, it doesn't really matter, for responding to the incentives. I think what we should do is just analyze these and try to see how we can fix that. So I would say Eurobonds in the current institutional setting seem like a very bad idea. And then I'd also say, and that's the last thing I'll say, sorry, this is kind of a long-winded answer, that Eurobonds won't magically create fiscal capacity. I think there's some confusion about this. What it mainly does is it reallocates fiscal capacity across countries, but ultimately, how much you can borrow is going to be determined by the surpluses, the primary surpluses that your governments collectively are willing to run in the future, right? There's no way around that. And so financial engineering is never going to create a ton of fiscal capacity. And what I've noticed in the discussion in Europe is that a lot of Europeans seem to put a lot of faith in the ability of Eurobonds to sort of magically fix all these fiscal challenges that are really driven by demographics, right? The population aging, growth slowing. And I honestly don't believe that a little bit of financial engineering will magically fix that problem. Ultimately, we're faced with a problem where it's very hard to run surpluses, and the bond market seems to understand that now.
Alberto, you want to take the floor on this Eurobond? Well, in Italy, there is, it's like a cyclical occurrence. There is the debate on the Hamiltonian moment, no? So we should mutualize, they say, the debts of all euro area member countries. 30% should be transferred on the balance sheet of the EU Commission, which, by the way, doesn't have any taxing authority. So it's not clear how the European Commission or European institution would pay back for which tax revenues they would use to repay this debt. But anyway, and in mentioning the Hamiltonian moment, they always take the first part. Okay, let's mutualize the debt, but they don't remember that some states did indeed.
Exactly. They always leave that part out.
Yeah,
yes.
Exactly.
So I think what we should do when Europeans cite the Hamiltonian example is always educate them about what happened 40 years later, where states were told the federal government is not going to bail you out. And I think we've never had that moment in Europe. And I think that fundamentally has created some pretty bad incentives. So I'm sympathetic to the idea that maybe Europe needs a Hamiltonian moment, but I think we need to be mindful of creating a system where the incentives are right. And it's hard to think of a federal system that works without serious limits on fiscal sovereignty. So I'm going to come back to the point I made earlier. Ultimately, it all boils down to that. And that's where I think Europeans are fundamentally different from Americans, right? So people there are large transfers within the US, say from California to Alabama. Why? Well, because the income tax system, the federal income tax system is very progressive, and California is richer than Alabama. But Californians don't get too worked up about this because, well, I think at the end of the day, they all think they're Americans, right? And I
Yeah.
think that's where Europeans are different. They do care about these things, and that's just and that's partly why Europe's so interesting, is because we value
Uh,
where we're from, but we're different from Americans
no,
in some
but
fundamental way.
I would
Yeah,
say without resorting to sophisticated theories,
yeah,
in the US, you
hmm,
vote for the federal government. So the
yes,
interests of California, Alabama, Maine,
yes,
Florida, Kansas, and blah, blah, blah are somehow weighted, and the result is a decision making process with hinges on Washington, on the federal government. In Europe, you have a political
hmm,
system where each decision maker is elected by its own
hmm,
electorate, so by a national
yes,
electorate. So the interests have to be somehow mediated at EU level by institutions which are not elected, and this creates this what's called the democracy deficit, and all the complaints that those against the EU like to underscore. But Alberto, your view on all this? What is your reaction to
I'm
what
blind.
we?
No,
Hmm?
no. No, explain to me again. You said at the beginning that no, monetary
The fiscal
transfer are in
transfers.
reality fiscal transfers,
right.
right?
So, hmm,
Say it again.
so you wanted me to go
Yeah,
over sort of the fiscal
yeah.
transfers again? Let's do that, because I think that's worth explaining in a bit of detail. So.
Hmm.
So in our paper, which and the title of the paper is "What Does It Take?" So it's kind of a play on Mario Draghi's famous London speech, where he said, "Whatever it takes." And what we do is we sort of try to compute these transfers, and the way we do it is really simple. Here's the idea: as I explained before, what periphery countries like Italy can do now in the current system is they can essentially borrow from Germany or the Netherlands, through this target 2 system, at the risk-free rate, essentially. So when, for example, um, the Banca d'Italia is buying back Italian government bonds, implicitly what Italy, the public sector in Italy, if you consolidate the Italian treasury and the Banca d'Italia and think of that as the public sector, what the public sector is doing is it's actually borrowing at the risk-free rate from Germany. Now, why is that a fiscal transfer? Well, it's because you're essentially you're getting a great deal, because if you went to the market, to the bond market would charge you a lot more, maybe 200 basis points more, maybe 300 basis points. So what we do is we compare the system we have now to a counterfactual scenario where there's no euro system, and Italy would have to borrow from the Germans through the bond market just by issuing bonds. And we use the market yields on Italian government bonds to measure this transfer. So basically, we're saying, look, Italy is getting a great deal because it can borrow at a risk-free rate through this target 2 system. Let's figure out how good that deal is. And it's a sizable transfer. So if you accumulate it between, say, 2013 and 2023, it amounts to 6 to 7% of Italian GDP. It's a bad deal for the Germans. That's the flip side, because they're essentially being asked to issue loans to lend to periphery countries, but they're not being compensated for the credit and the currency risk. And if you add up the subsidies that Germany is paying to the rest of the Eurozone system, it's sort of roughly 10 to 11% of GDP over the same time period. That's cumulative, right? It's not per annum, it's between 2013 and 2023. And that's, let me just add, it's a conservative calculation, because what we do is we actually take the observed market yields on Italian government bonds. But as we've discussed before, the whole reason for the ECB to expand its balance sheet and buy back Italian government bonds alongside German bonds and Dutch bonds is to lower the spread, partly, between Italian government bonds and German bonds. And in fact, there's a lot of empirical work that documents that it does just that. We're not even taking that effect into account. We're just taking those market yields as given and computing the transfers. But if you were to say, well, Hanno, in a counterfactual, you'd have to think about the ECB not buying back bonds, and the spread would be higher. That would mean that the transfers that we'd compute would be higher as well. Okay, so in that sense, it's a conservative calculation. But the bottom line, coming back to your question, Alberto, is yes, when the ECB runs a big balance sheet and when it's expanding its balance sheet, it is allowing the periphery a good deal. It's giving the periphery a good deal by allowing it to borrow from the core at below market rates, right? So it's a good deal for the periphery. It's a bad deal for the core because, say, taxpayers in Germany are implicitly, through the Bundesbank, asked to take on credit risk and currency risk, but they're not being compensated for it. So if you're a German taxpayer or a Dutch taxpayer, you'd look at this and say, what's in this for me? This is a bad deal. If you're an Italian taxpayer, it's a good deal. Although, actually, this is the last point I should make. It's not as great a deal for the Italian taxpayer as you might think, because a lot of the subsidy is then given to Italian banks who are allowed to borrow at below market rates from the Banca d'Italia. So it's Italian banks that benefit to a big extent, more so actually than Italian taxpayers. But that's a sort of a detail that maybe we can talk about more.
But there is a leg of this reasoning
Thank you.
I think just one second, Alberto. I would like to point out. The other difference between, let's say, the US and the euro area is that if an Italian entrepreneur wants to get a loan from a Finnish bank, he can't. So this interbank transfer operation reserve actually do not lead to a better credit market because the banking system in the euro area is balkanized. No, because if a Greek saver, if a Greek investor can freely open a bank account in Dresden, but the Greek entrepreneur cannot get a loan from a bank in Dresden or wherever in Germany, that means that the capital flight is permanent and not reversed through market mechanisms. Am I hitting a nail here, or am I just overstating, exaggerating a problem?
No, I think you're right. We sort of have a banking system within the Eurozone that is fairly balkanized, and it's kind of important, I think, to take a step back in time. Before the Eurozone crisis started, there was an active interbank lending market. And so if there was excess liquidity in Germany, and there was a need for liquidity in Italy, what could have happened is that UniCredit would have borrowed from Commerzbank through the interbank lending market. That market froze during the Eurozone debt crisis. But then what's essentially happened is that the ECB essentially positioned itself as the intermediary, and sort of we've sort of taken private banks out of this intermediation process and substituted the European Central Bank. using target 2 and a big balance sheet. And that's kind of why we're now stuck in this more, what you called appropriately, a balkanized system. It's partly because the ECB has taken on the role of being the super intermediary in the Eurozone that is sort of making sure that excess liquidity in the core gets deployed in the periphery. But the key problem is that it's not happening at market rates because it's not a market process. Yeah. And of course, as you said, that's not a sustainable system. It's a system that implies large transfers. Implicitly, it's a tax on folks in the core, taxpayers, and a big subsidy for people in the periphery. These transfers, by the way, I should add, are somewhat appealing to policymakers, I think, because the people who are being taxed, I don't think they understand they're being taxed, right? If you're in Germany, I don't think you wake up in the morning and think, boy, there are these huge transfers implied by this target 2 system. That's too complicated. People don't really understand. And that kind of speaks to the democratic deficit that you mentioned. I think we should be worried about the fact that there is now a large institution, the European Central Bank, that is run by officials who are not elected officials. They're not appointed by Italian voters or German voters or Dutch voters or Belgian voters. And the idea was that they were going to be independent, which I think is very important, but that they would stick to a very narrow mandate. And in fact, if you read the mandate, it's super narrow. It's narrower than the mandate of the Federal Reserve. It says price stability. That's basically it. There's some qualifications, but basically their mandate is price stability. But what has happened, I think, is that the ECB, because of the history of the Eurozone debt crisis, I'm not blaming anyone in particular. I can see how we got here. It has now taken a very expansive view of its mandate. And you hinted at this in your introduction, it seems to have created a de facto fiscal union without a mandate from voters. And I think that's very bad for Europe. And the reason I think it's bad is because I'm a European and I'm a big believer in the European project. I think it's been overall a big success, actually. But I think by doing this, we're jeopardizing the whole thing. I think we're taking a huge risk, and we're maybe in the short run making things easier, but we're creating a huge risk for our children and our grandchildren in Europe because this is not a sustainable system, I think. Yeah.
Alberto, your comments on this.
So you think this system by which the ECB monetizes the debt of the peripheral country is intrinsically unstable because it rips off the rich countries?
It's sort of, yeah. By the way, I should say, this is kind of a sensitive issue, but we're seeing which countries are core and which countries are periphery. It's changing, right? So that's another interesting thing. I mean, maybe 10 years ago, and in our paper, you would have thought France was solidly a core country. Now the market seems to be telling us maybe not. So it's really about, when I say core and periphery, it's kind of maybe an unfortunate term. But what I really am talking about is countries that have some fiscal capacity left. And those happen to be maybe Germany, the Netherlands, Finland, maybe a few others. And then you have countries that have exhausted their fiscal capacity, and it looks like France is now in that club. And yes, what I'm saying is that essentially we set up a system where we're kind of taxing taxpayers in countries that have behaved fiscally responsibly, like the Germans. For better or for worse, Germans have sort of been fiscally quite responsible, I think, in the way they've managed their government budget. But now what we're doing is we're kind of saying, well, you know what? We're going to penalize you, and we're going to transfer some resources from German taxpayers to taxpayers in Portugal, in Spain, in France, And that's, I think, as you hinted at in your question, not a sustainable system. I think sooner or later,
No.
a
No.
question will be asked by maybe a populist politician in Germany, where he or she says, "Wait, why did we join a club where I thought the only idea was that when I went on vacation, I wouldn't have to change my Deutschmark into Spanish pesetas, but now it turns out that I'm on the hook for big transfers." I think ultimately, I think it's not a sustainable system because it's not clear what's in it for German taxpayers. And so that's why I'm worried that in setting up this system, we're ultimately putting the Eurozone on a dangerous trajectory where its demise in the long run seems almost inevitable unless we change the way this works. And I personally think, from my own work looking at this, that the only way we can go back to a system without large transfers is for the ECB to go back to running a small balance sheet. So let me just make that simple point because this is kind of important. Central bank balance sheets in the Eurozone, I don't know if you know this, but they really exploded. So in 2021, the Bundesbank's balance sheet was more than 80% of German GDP. The Banca d'Italia's balance sheet was more than 80% of GDP. If you go back 20 years or 30 years, a typical central bank balance sheet was between 5 and 10% of GDP. These are humongous numbers. In order to eliminate the transfers, what we would have to do is just go back to running a very small balance sheet, between 5 and 10% of GDP. And I think that would be a great first step to eliminate these transfers, Alberto. So I think, I think that way, at least, we could sort of make sure that the Eurozone is in good shape and survives as an institution for the next generation. Yeah.
Thank you. Thank you, Hanno. I got it.
There's
Fabio, I have to go now.
you have to go now. Okay, then let's leave it like this. I think we have given a very comprehensive picture of the situation. Maybe next time, in the next episode, if Professor Lustig is so kind to accept our invitation, we can talk about things linked to the war in Ukraine, the German military expenditure, how this will impact the fiscal capacity to manage this transfer, and so on and so forth. But for the time being, Professor Lustig, many thanks for your kindness, and we hope to have you on this channel in the near future once again.
Thank you.
Thank you, Fabio. Thank you, Alberto. This was a lot of fun. I'd love to do it again.
Thank you.
Okay, thanks.
Okay.